Hello everybody. In this video lesson, we will see that interest rate parity theory in order to ascertain forward rate. So what this theory says, it defines the relationship between the interest rates and the exchange rates of the two countries. Meaning this theory tells that the forward premium or discount on a currency should be equal to the interest rate differential between the countries concerned. So the highest interest rate on a currency is offset by the forward discount and low interest rate is offset by the forward premium. Yeah, this should be low interest rate is offset. Yeah, so in other words, we can say this states that the exchange rate differential between forward rate and spot rate will be equivalent to the interest rate differential between the two countries. That is, it equates the interest rate differential to forward premium or discount on the foreign currency. Just to give you an example, suppose between US dollar and say Hong Kong dollar. Hong Kong dollar currency interest say per annum 10%. I am just giving one example, 10%, and US dollar currency interest is say only 3%. So the forward rate between forward rate and the spot rate of foreign currency, that difference would be equating to the interest rate differential. Here what I took that example, it is 10% and 3%. So roughly it is 7%. So forward premium or discount also will be close to 7%. We will see. So if we put it in a equation, it would be like exchange rate differential equals to interest rate differential. So what we can put? We can put forward rate by spot rate. This ratio should be equal to 1 plus interest rate in home country divided by 1 plus interest rate in foreign country. So from that equation, simple math, I can get forward rate, which is nothing but spot rate into 1 plus interest rate in home country, that's numerator, divided by 1 plus interest rate in foreign country. So this way we can ascertain forward rate. So what does it mean? It means if home currency interest rate is greater than foreign currency interest rate, then foreign currency should be traded at premium. On the other hand, if home currency interest rate is lower than the foreign currency interest rate, then foreign currency should be traded at discount. Let me show you one illustration. United States dollar is selling in India at rupees INR 65.50. If the interest rate for a 6-month borrowing in India is 8% per annum, this interest is given per annum, and the corresponding rate in USA is 2% per annum, do you expect that US dollar to be at premium or at discount in the Indian forward market? And what would be the expected 6-month forward rate for US dollar in India? And what would be the forward premium or discount? So that is the sum. Once again, US dollar selling in India at rupees 65.50 and 6-month borrowing in India. So interest rate is high in India. Yeah, 8% per annum, and corresponding borrowing rate in United States is 2%. So interest rate is lower in USA. Here, USD is expected to quote at a premium in India as the interest rate is higher in India and lower in US. So, as we see that forward rate we can calculate spot rate into 1 plus interest rate in home country. So, home country here dollar is my foreign currency. Spot rate for that foreign currency is going on 65.50. So my home country rate is 8% for 6 months. So 6 months, it is 8% per annum. So for 6 month interest rate would be 0.08 by 2, and interest rate in foreign country, in US that interest rate is 2%. So for 6 month interest rate would be 0.02 by 2. So it is 65.50 into 1.04 by 1.01. This, if you do math in calculator, it is coming 67.45. I hope I have calculated correctly. Let me check once. 65.50 into 1.04 equals to divided by 1.01. 67.45. So 67.45. So this is my forward rate. So here forward rate is 67.45, spot rate is 65.50. So my premium would be 67.45 minus 65.50. So forward rate minus spot rate divided by spot into 100, and this difference is for 6 months. So for annualized it is into 12 by 6. So let me see. Let me clear this. 67.45 minus 65.50. This is the difference, divided by spot rate 65.5 into 100 into, it is for 6 months. So if I want to do annualized, that means 12 by 6. It's nothing but 2. 5.95. So rate of premium is 5.95%. This is annualized. Yeah. Hope I am clear. So interest rate parity actually plays a very significant role in foreign exchange market, and because it is enforcing a very essential relationship between the short-term interest rate and spot exchange rate and forward exchange rate, and it really works wonder in international capital market when there are no restrictions for flow of fund from one country to another country. So in my next video lessons we will try to see some more illustrations to make these things more clear. Thank you.